Hi, welcome to this video. We're going to develop now chapter 31, Open-Econony Macroeconomics, Basic Concepts. Remember, this is a book of Gregory Mankiw, Principles of Economics. So, first, as we know, at this point we are going to talk about decision of different products of different countries. This is how usually people face even every single day. For example, when we talk as well on vacation, if you're deciding on going to your country, an internal voyage, or you are thinking on going abroad, so you need to verify which should be the best idea. Or maybe you think maybe you can save some money and you can buy stocks, and naturally these stocks can be from another country. So at the end of the day, when we have this trade available, the consequence is that people can produce in what they are better. So as a consequence, we have a great variety of goods and services. And the situation that we saw before in the 10 principles of economics is like trade can make everyone better off. The conclusion is like the comparative advantage should be the one that provide who is going to produce something. So this is the comparative advantage. Because of this, the trade exists. Before, during all book, we assumed closed economy. It means that there is no operation with other countries. There is no transactions with other countries. In this case, we're going to start to talk about relationship between them. So this is the new features that we are going to start to study, and we are going to set the basis and the basic concepts in order to go a little bit deeper. So first, we are going to start talking about the international flows of goods and capital. So there are two ways to interact with other people. So one should be buy and sell goods and services in world product markets, or you can buy and sell capital assets as stocks and bonds in world financial markets. So once we have more about the finance part, and the other one, the real one, which is the goods and services. The exports are domestically produced goods and services that are sold abroad. So those products are produced inside a country, but they are sold outside. The imports are foreign produced goods and services that are sold domestically. So let's put an example. The Boeing, which is an US aircraft manufacturer, builds a plane and sells to Air France. So there is an export from US to France, and from the France point of view, there is an import, which is the Boeing. Let's think about a Swedish brand, which is Volvo, which is a car manufacturer. This brand, this company, makes a car and sells it to US resident. So this is an import for US and export for Sweden. So net exports should be exactly equal to the total value of the country's exports minus the value of country's import. Then the trade balance, if we have, this is what we call the trade balance. So first situation, we have value of country's exports higher than value of country's imports, is what we have a trade surplus. Or the case when this value is less or less from the exports compared with import, so we have trade deficit. If they are the same, we say that there is a balanced trade, which is not common at all. There is always a difference between them. So a changes in trade balance could be the next situation. Imagine the situation that the tastes of consumers for domestic foreign goods changes. So if that's the case, there should be a different consumption or different demand for for those products, or the prices of goods at home and abroad. We already know when the price is higher, you tend to consume less of that good. Or this is a new thing, the exchange rates at which people can use domestic currency to buy foreign currencies, or the incomes of consumers at home and abroad, and naturally the cost of transporting goods from country to country, and government policies toward international trade, as for example some tariffs. So here is a situation with real data. This is the situation for US economy. We have here as a percentage of GDP. Remember, the GDP is consumption plus investment plus government expenditure plus net exports. So here we have the situation of exports over GDP and imports over GDP. As you can see here, from the very beginning until 1975, usually the exports were higher than imports, what we call trade surplus. After that, we see how the imports have been naturally higher than export, so we are in a trade deficit for US economy. Furthermore, another important fact that we have here is like the representation of imports and exports compared with the total GDP is higher with year by year, is what we said, that there is an increasing openness of US economy, and actually for most of the countries they have the same relationship. Then here, why we have this increase of openness in countries? First, the cheaper cost of transportation. So with the all advances that we have been experiencing during the last years, it makes a factor that trade is easier between countries. It's a better communication. So for example, before maybe the languages, it was like a higher barrier, but now because of the more tools that we have with an email, with some like global English as well, so we can make transactions like easier than before. And naturally, you know that there is a lot of trade of devices, and usually the devices, they have a high value per weight. So for this reason, it's cheaper to have like some producer chain in other country, because even with the transportation costs, we have lower costs in total, in terms of the wages, in terms of the land and the all materials to produce there, in terms even taxes. So for this reason, it makes like these devices, they are produced in different countries around the world. And naturally, with the openness of different countries with different trade agreements, we are facing a better condition and lower cost for everybody. So before we talked about the goods and services, now we're going to discuss a little bit about the financial resources, what we call the net capital outflow. It's like the similar situation of the net exports. So then, the net capital outflow. So we have, for example, imagine the situation that you have money, so you can buy a car from Toyota. It means naturally an import, right? Or you can invest this money in Toyota's stock. So it's not the same. We are talking about this capital outflow. So this transaction is a flow of capital. So it's pretty much similar as before. The net capital outflow is exactly equal of the purchase of foreign assets by domestic residents minus purchase of domestic assets by foreigners. So in the first situation, so we have an US, for example, US resident buys a Petrobras stock. So this is a purchase of foreign asset by domestic resident. So there is an increase. So the other situation, we have a Japanese resident buys a US bond. So this is the second situation. So the net capital outflow decreases. Then, for example, imagine the situation of McDonald's opens a fast food in Russia. Is what we call foreign direct investment. Or the other situation of capital outflow, we have an American that buys a stock in a Russian corporation. This is a foreign portfolio investment. What are the difference between them? So the first situation, the owner manages investment because he or she controls the business, right? But the second situation is more passive. You just put your money there and you're waiting for some return of that investment. But both cases are situation of net capital outflow. So the net foreign investment should be positive or negative. So what about if it's positive? If it's positive, domestic residents, they are buying more foreign assets than foreign are buying domestic assets. So we say that capital flowing is going out of the country because as American they are buying more outside compared of people outside they are buying from their country. So this is a positive. Negative. Domestic residents are buying less foreign assets than foreigners are buying domestic assets. So more money is coming to the country, so we have a capital flowing into the country. So, what determines this capital outflow behavior? Well, first, the interest real paid on foreign assets, then the interest real paid on domestic assets, the perceived economic and political risk of holding assets abroad, the government policies that affect foreign ownership of domestic assets. So, let's talk about the quality of net exports and net capital outflow. So we already saw them independently, so we're going to have now a look together. So then, the net exports, we know that it measures the imbalance between a country's exports and its imports. And the net capital outflow measures an imbalance between the amount of foreign assets bought by domestic residents and the amount of domestic assets bought by foreigners. So for an economy as a whole, we have this particular equality. Net capital outflow should be exactly equal to net export. At first glance, it's kind of difficult to understand that idea. But basically, every transaction that is made in one side should be reflected in the other. So let's put that in an example. So we have someone who export some good to Japan. When you export that good to Japan, you receive something in compensation as a sale. So you have 10,000 yen. So it increases net exports of United States. Until that, so far, so good. Then, imagine that you receive this 10,000 yen, but if you don't make anything, you will keep the yens under your mattress. So, you are investing in foreign assets, in Japanese yen. Okay? So then, the increase of the net exports match exactly with the increase of the US net capital outflow. Or maybe imagine that you don't keep just this yen there because for you they're like useless. So you take this money to buy Japanese stocks or bonds. Okay, exactly the same. It matches because this is an US net capital outflow. Or the other case, you use this money to buy a good made in Japan and you bring this good back. So then your the import increase in the exactly amount of the exports, so it matches. Now we are just affecting the goods or the trade balance, not the net capital outflow. So exports and imports increase in the same amount in this last example, so net exports are unchanged and no impact in the net capital outflow. Now imagine that you go to your bank and change this 10,000 yen because you need US dollars. The bank will do the same with the 10,000 yen. they can keep, so this is investing in a foreign assets. They can buy some good, but in order to buy some good they need to change to dollars, so the process will be the same, and it matches exactly net exports equal to the net capital outflow. So imagine other situation. Imagine that Walmart buys a 50 million in clothing from China. So this is naturally an import, but China can use this money to invest in US stocks. So we have a decrease in net exports because of an increase in imports by this clothing, and a decrease in net capital outflow because of foreign people they are investing in domestic assets. Or China can buy a plane from Boeing. So first there is with this money decrease in net exports because of China, and then an increase in net exports because of the sale of Boeing. So here we have situation of net exports higher than zero. It means we are selling more goods and services for foreigners that it is buying from them. So this excess in foreign currency should be to buy foreign assets, because we cannot use that money in our country, so we need to buy with this money what they receive. So we have to invest that in foreign assets. So as a consequence, net exports higher than zero, we have a net capital outflow higher than zero. Now imagine that the net exports, they are less than zero. So we are buying more goods and services to foreigners than it is buying from them. And in order to finance this deficit, we are selling these assets abroad. So more people outside our country, they are investing in our country, and with this we are financing these net exports negative. The higher in imports compared with the exports. So now that we understand better that situation between net capital outflow and net exports, we are going to discuss a little bit about the role of saving, investment, and the relationship with the international flows. So we know that the saving and investment is one of the two key factors for any economy, and even for every person. If you are saving, if you are investing, this is like postponing your consumption in the future. Or maybe if you are investing, you are trying to invest in capital, right? And this capital, this is the idea to have more productivity, which is as a consequence more goods and services, which bring like better well-being for all people. So saving is equal to investment for a closed economy. We saw that relationship. And now we have this complete definition of gross domestic product. Before we have just C plus I plus G, and if we put C to the other side, G to the other side, we have the total income minus the total consumption split by the private plus the public should be the saving. So the saving is equal to investment, where net exports are equal to zero. So now we have that this is the S, this is the saving. So we just replace here, and we have we put the C and G, and we have I plus net exports, and this one we have the S, this by this definition. So in this situation, saving is not anymore equal to investment. We have something else. We have savings equal to investment plus net exports. And remember that net exports are exactly equal to net capital outflow. So saving is exactly equal as investment plus net capital outflow. So then, when an US citizen saves $1 of her income, which should be this S, that dollar can be used in two parts: to finance the purchase of foreign capital, or you can use for investment. So imagine my family. My family cruise saves money for retirement. So this money goes to mutual fund. So this mutual fund can invest this money in Ford stocks. We are talking about domestic asset. But Ford will invest this money in some product, in some project. So we have here that family, our money is to be invested in our country. Or these mutual funds can take this money to buy some foreign assets, some Toyota stocks. So this is net capital outflow. So this is how $1 saving can go to investing or investment, or it can go to net capital outflow. So here we have, in order to summarize, to have these ideas well understood. So when we talk about trade deficit, it means the exports are lower than the imports. So when we have this one, exports minus imports, this should be negative. So net exports should be lower than 0. And then Y should be lower than C plus I plus Z. To tell you the truth, this was not easy, for me to understand that. So let's put something here. So here we have the GDP. And imagine that Y is 10. Imagine that the net exports are minus 2 because we are in a trade deficit. So necessarily, in order to fulfill this one, this C plus I plus G should be 12. So as you can see, Y is less than 12. So when this is lower than 0, Y is lower than C plus I plus G. So it means that the saving, which is exactly, the saving should be lower than the investment. Again, why this situation? Let's put this one. We know that S is equal to I plus net capital outflow. If this, we know that it's exactly equal to net exports. In net exports lower than 0, this should be lower than 0. So imagine we have 12, we have again here 14, and we have here minus 2. So in this situation, we have 14, S lower than I. And then net capital outflow is minus 0 or lower than 0 because it's exactly equal to the net export, right? Then other situation, balanced trade. So we have exports equal to imports. So this is the easiest one. Net exports is equal to 0. So here we have like as a closed economy, Y equals C plus I plus G. Saving is exactly equal as investment, as autarky, or as closed economy, and net capital outflow should be equal to 0. Last situation, trade surplus. Exports higher than imports, so it means net exports higher than 0. So this is the opposite. So here we have, for example, Y12, net exports 2. So we have here the C plus I plus D should be 10 in order to fulfill this equation. So for this reason, so we have Y should be higher than C plus I plus G. And then we have saving higher than investment, and we have a net capital outflow positive as net exports. Here is an important fact that we think maybe a common citizen, that this person doesn't have any knowledge about economics, and maybe they say, okay, what do you want? A trade balance, surplus or deficit? And more people, I prefer export more what I import. Well, that's a tricky one because it depends how you make, what is the consequence of that. So by itself is not bad or good, it depends. So for example here, we have the national saving and domestic investment as a percentage of GDP. So you see here the national investment, we have this S, and here we have the I. And remember, if we have S is equal to I plus XN, under this second situation, when we have S higher than I should be necessary. Sorry, that's not the case. Actually, should be I higher than S. So in order to fulfill that and to keep that, we have that the xn should be lower than 0. So we are in a trade deficit. So in this case, this trade deficit is a national problem because US is like the highest debtor around the world. So that's the key point of this situation. So after 80s, as we saw, we have a net outflow capital negative, right? So it means that we are asking for more money abroad to buy domestic assets. So we have S equal I plus nx. So it's, as I show you, I higher S. This is the situation. And then we have the other analysis that we have. So we know that the net exports is negative. So here is how much is negative, or how high is negative compared as a percentage of the GDP. So this is all when this was at this part it was positive. So it was because we were in this part where slightly the national saving was higher than domestic investment. So here we have this situation positive. Then it starts to be negative because the investment higher than saving. So we have we need to split that in different situations to understand better. Between 1980 and 1987, we are here. There is a decrease. There was a decrease of national saving. So this was why we have this net capital outflow, which was decreasing more. And it was when we have a decrease in national saving, we have a decline in public debt savings. So as a consequence, it was the situation in that particular. So we have a government budget deficit. Remember, the income of the government is the taxes, and then the spending is what they make. So in this situation, we have a spending higher than this income. So we have a budget deficit. So the situation here was like Ronald Reagan cut taxes and increased defense spending. So it was a double situation. We'd make a higher hole in deficit or in the budget of the government. In situation between 1991 to 2000, so we are here, again, an important decrease. It was because of an investment boom. So we have an investment boom of this. So for this reason, investment higher than the savings. So we have a net exports or net capital outflow considerably negative. So actually there was no explanation of saving at that particular part, and actually because in this situation even the government was in a surplus situation. So the taxes, the income was higher than the expenditure. And the last part, which is from 2010 to 2015, is the economic downturn and recovery. We have here recovery after that. So here was like a capital flow into the US remained large, and from 2000 and 2009 we have this accumulation of less profitable capital. So for this reason we have a budget deficit for downturn. So for this reason we was like a decrease in the economy. So then the question, is it bad when we have a trade deficit? Well, we have, for example, situation when there was a fall in saving that occurred during 1980s. So people are putting less money for the future. So in this situation, there are no changes in net capital outflow. It just originated for the fall in saving. So remember the situation: saving equal investment plus net capital outflow. There was a decrease in saving, so net capital outflow remained the same, so investment decreased as well. So this is really bad because it affects the capital growth because we are not facing investment. Then when we don't have capital growth, it affects productivity, and as a consequence it affects the real wages. The other situation is when we have compensated this debt because of an increase of investment, so could be better foreign investment. So this trade deficit can induced by an investment boom. So the situation here is like economy is borrowing from abroad, which is the net capital outflow negative, but this is to finance the purchase of new capital goods. So we have a decrease in net capital outflow, the saving remained the same, but it was an important increase in investment. So this is good because we have new production of goods and services, but that was converted in order to convert that debt, in order to cover that debt. So the situation is the next. If we are making some loans for being more productive, they're okay. But if the investment is not profitable, could be less desirable. So trade deficit is not a problem itself, but sometimes can be a symptom of a problem, for example in the case that we have a decrease in saving. Then the prices for international transaction, real and nominal exchange rates. So we are going to start discussing the nominal exchange rate. So we know that the prices are the one like the invisible hand, as Adam Smith predicted that the prices is the correct one to allocate resources. So this can be exactly the same as when we have exchange rate. So a person can change local currency for foreign currency to buy goods or services abroad. So in the case of Mexico now, more or less you give $1 and you receive 24 Mexican pesos. So we are not taking into account that there is a difference when you buy or the exchange shop they sell. We are assuming like a normal price, exactly the same sell or buy. This is an unique price. So with the US dollar, you receive more of Mexican pesos. If there is this is a dollar appreciation, but in this case, for example, you receive 25 pesos, so this is a dollar appreciation. If you receive less for $1, this is what we call depreciation. So for example, we receive 23 Mexican pesos. So for this reason, in the news we can see that the currency is strong or weak depending on what situation this is present in. So now we're going to have a look on real exchange rates. So this is the rate people that can trade goods and services of one country for the goods and services of another. So for example, imagine that a bushel of American rice is $100 and in Japan, Japanese rice is 16,000 yen. So here, if 80 yen is equal to $1, so I provide $1 and I receive 80 yen, so we have that the American rice in yen should be 80 times 100. So we have American rice in yen 8,000. So as you can see here, we can compute that the real exchange rate is exactly equal to the nominal exchange rate times the domestic price over foreign price. In this case, what is the nominal exchange rate? 100. What is the domestic 80. What is the domestic price? 100. And what is the foreign price? 16,000. So we have 8,000 over 16,000, we have 1.5. So it means that in United States this is like half of the price of Japan rice, because we just have 8,000 compared with 16,000, 1/2. So then at this situation we focus in overall prices instead of individual price. So we make exactly the same, but we take into account with the CPI, which is the Consumer Price Index, and we compare the real exchange rate between countries. So the P should be the US basket, the CPI for domestic products. The P star should be the foreign basket. So we are going to take the previous example just to overall prices in the economy. And the E is the quantity of foreign currency per dollar. So the real exchange rate is equal to the nominal one, which is the E, times P over P star. So basically this real exchange rate, it measures the price of a basket of goods and services available domestically relative to a basket of goods available abroad. Remember, above was like the price of the American rice in terms of yen and over the price in Japan. And now we have here, but for all overall prices. So it is a key determinant for net exports and net imports. Why? Because if you have a dollar with, you just provide $1 and you have more of this good abroad, so you have appreciation of your money, and when you have appreciation of your money, it's better to buy abroad. Your money is stronger. When you have the opposite, when with this dollar you can buy less currency, your money is weaker. So for this reason, it's better that you put this money or your goods outside as an export. So this is a key determinant for net export and net imports. So depreciation in US real exchange, so US goods have become cheaper relative to foreign goods. So then consumers at home and abroad have more incentives to consume US products. US exports increases and imports decrease. When we have the other situation, when there is an appreciation, so the US goods are more expensive relative to foreign goods. So you're not like kind of competitive. So consumers at home and abroad have more incentives to consume foreign products. So then the US exports increase and import decrease. So now we're going to discuss with this basis a theory like this basic one, first theory of exchange rate determination, which is the purchasing power parity. So here we have the basic idea of that theory is that a unit of any given currency should be able to buy the same quantity of good in all countries. So this is based on the idea of law of one price. So if you go to buy milk from one neighborhood and you try to buy this milk to another neighborhood, this milk price should be exactly the same. So here, for example, if it's otherwise should be an opportunity for profit for one side. Imagine that we have an example of Seattle and Dallas. For Seattle, we have a $4 a pound of coffee. And here we have Dallas, $5 a pound. So what should be the opportunity? The opportunity is that you are taking profit without any risk. So this is like opportunity taking advantage of arbitrage. This is definition of arbitrage. So for example, you can buy in Seattle and sell in Dallas. But when you start to make too many times that, so we have like more supply in Dallas and less supply in Seattle. So makes the converge the same price, because this starts to go up and this starts to decrease until being the same, and until the arbitrage possibility should be equal to 0. So according to this theory, this can be applied for international marketplace. So what we have here, we have as a consequence that the exchange rate over the prices should be exactly the same. So if we have, for example, 1 pound of coffee, 500 yen, and the nominal rate is 100 yen, and 1 pound of coffee, we have $5, because we have this one, 500 over 100. So then we have P basket price in US and P star basket price in Japan. E nominal exchange rate. So if we are purchasing power at home, well, here we have the number of yen and $1 can buy. This is the nominal exchange rate definition. So here the purchasing power at home of $1 should be $1 over P. If, for example, the price is equal to $1 can purchase one good, and a dollar can buy 1 over P quantity of goods. When we change a dollar, we get E of a foreign currency. So this is your purchasing power abroad. So which is exactly equal to E over P star. So according to this theory, the purchasing power in both countries should be equal. So if they are equal, your purchasing power at home is exactly equal to your purchasing power abroad. So if we just rearrange, we have 1 equal to E times P over P star. So this specific part to the right of the equation is what we called the real exchange rate, which means the relative price of domestic and foreign, the real exchange rate that you can buy a good outside with your money. So if this is equal to 1, to a constant, the relative price of domestic product and domestic and foreign product cannot change. And then we can rearrange this one to the nominal exchange rate equal to the price star over price inside. So then this nominal exchange rate between the currencies of two countries must reflect the price level in those countries. So the nominal exchange rates change when the price level change, because in order to the price level adjusts to bring the quantity of money supplied and the quantity of money demanded into the balance, as we saw before, that when we have more money supply, the value of the money is lower. When we have less money supply, the value of money is lower. So the nominal exchange rate depends on money supply and demand in each country, because remember, the prices in an economy are determined mostly for the quantity of money that there is in an economy. So when the central bank prints large quantity of money, this money loses value, but both in terms of the goods and in terms of currencies it can buy. So here, when we have an increase in our in the other economy in P star, we have a higher nominal exchange rate. So I receive more of the other currency for $1. When the other situation, for example, here is an important fact of real life. So US dollar lost value compared with German mark and earned value compared with Italian lira. So in the first situation, we have that the P star increase. So for this reason, I receive more for $1, which is the case of Italy. And the other case, the prices in United States increase more than in Germany. So we have here a decrease of the nominal exchange rate. So it is the situation of Germany. So now both countries have the same currency, which is the euro, and then they have a single monetary policy, but the exercise could be done exactly the same. So let's have a look to the nominal exchange rate during a hyperinflation. So as you know, as economists, we cannot perform experiments in a laboratory as other sciences. The only experiments that we can perceive, the ones that they are happening in the real life. So hyperinflation, as you know, is the exaggerate increase of overall prices in an economy. It happens when money is out of control. So this is an example for Germany between the after the First World War. So here we have the price level increases, but it was together with the quantity of money supply printed by the government in order to finance the war. But as a consequence, we have here the loss of the German mark. So for this reason, for $1 I can receive more and more and more and more German marks. So it was a depreciation of its money, but from the US economy, an appreciation of the dollar. So we can see here how this theory makes sense in real life. So we have an increase in money supply that we saw before. As a consequence, we have an increase in the price level, and then we have a decrease in the exchange rate. So dollars for the mark. So here we have an increase, total increase of internal prices, which makes the nominal exchange rate from Germany will be lower and lower. Then, what are the limitations of this theory that we already developed? Well, actually, we cannot predict how exchange rates are determined. This is not the only situation. And actually, we can not make sure that $1 has the same real value around the world. Why? Because first, many goods are not easily traded. So for example, haircuts, if you pay lower haircut in India compared with the United States, there is no possibility to make any trade and go to United States just for a haircut. Second, tradable goods are not always substitutes. So for example, some cases you have German cars preferences, or other you have American cars. So for this reason, we cannot compare easily both goods. So here is an interesting revision how this power purchasing theory can be like applied. So it is made by the Big Mac index provided by The Economist, which is an international magazine. So they try to compare, okay, if the unique low is clear, so I need to buy a Big Mac exactly by the same value as I buy a Big Mac in other country. This is what theory predicts. So let's see. We have a Big Mac price, which is a standard product, and it is around the world. So predict theory is that the price should be the same. So in dollars, it's approximately $5, like approximately like 4.93 for this table. So for example, if we have $5 in US and we have 500 yen, so it means that the purchasing power, it is the cost of a Big Mac in Japan. It predicts that a purchasing power parity says that the cost of Japan should be 100 yen. So this is the situation. So for example, this is the cost of a Big Mac in Indonesia, 30,500 rupiah. If I exactly take the value of this good in United States, so it means that the predicted exchange rate should be 6,187 rupiah for $1. But the real one is this one. So we have here a difference. So let's have a look here in the situation, analyze a little bit better for one specific country. So the price in the US is 4.93. So this is a reasonable first approach. They are kind of similar, but imagine this means that there is an opportunity or arbitrage. Why? For example, you can buy a hamburger in Mexico for 49 pesos. This in dollars with the legal or the official exchange rate should be 49 over 17.4 pesos. So the cost is really $2.81. So you can go to United States and you can sell for $4 because in that place it costs 4.9. So you can get this money back home and you multiply by this 17.4 and you have 69.6 Mexican pesos, which is higher than 49 pesos. It means that there is opportunity of arbitrage. But again, it's not possible that you buy a Big Mac and you take a flight to another place to sell that product. So this is an interesting way how this is some approximation, but naturally this is not complete accurate. As a conclusion, we saw how saving and investment differ in an open economy. We had a look when we have trade surplus, And when we have a trade surplus, we establish that it must be sending capital outflow, right? When we have this one, when we have higher than this, so sending capital outflow. So when we have a trade deficit, we should present a capital inflow, and we had a look at nominal and exchange rates. Okay, I hope you have enjoyed this amazing chapter. I really like it. I think that is really interesting, and this is really close to real life, a lot of facts here. So thank you so much. Thank you for watching this video, and see you next time. Bye bye.